Sandeep, hi, good to have you with us. How have you been?
Good, Ashu, and this has been a long time in the making. I think we spoke a few months ago, but finally, great to be here on the show.
Sandeep, completely agree. And, this is a session that I've been looking forward to, right? And largely because, wealth is something which is very close to my heart. I started my career within the private banking space around the time it was coming into India. But I think over a period of time, it's evolved, right? I think money management has taken a very different kind of a turn. It's become so much more intelligent, right? From what we started to do in the early days of managing money for HNIs, ultra HNIs, family offices, right? To
Yeah.
what the way we're doing it today, right? And the economy has become so much more exciting, right? Thus, it becomes a very important and an exciting conversation, right? I think the rules of the game have changed. You are, building an enterprise with those changed rules. Evangelizing investment in assets in a more dynamic way, right? I think which is just so much more important, right? So this becomes an important conversation in that context. Sandeep, before we start, I'd love you to give us a quick, run into the background, right? You've been a professional who's been out there. You've seen this industry evolve. Of course, I'm not referring to your age, right? But with all the experience, right? You've seen a lot of those cycles. I'd love to have a quick, insight on that, and then we dive into that.
Sure, Ashu. I think it's first of all, thanks for having us on the show. There's so much that's changed in the last 15 years that I've been a part of this industry. I remember when we started, wealth managers or investment advisors were not really looked up to. If you remember the days right after the Ketan Parekh debacle that had happened in early 2000s, and then there was 2004, 5, and then 2008. I think a lot of the blame for what happened to portfolios landed at the door of the wealth manager who was advising the client. So I think from that to now, I think the journey has been really interesting. From a point where you had to tell people that you need to invest, to the point today where people are asking you how to invest. I think India has come a really long way. And for me personally, I think that's been the real interesting part of it. For the first 15, 16 years, right out of B school at IIM Bangalore, I came into wealth management initially with Kotak, and then was a part of the founding team at IFL Wealth. I think interesting learnings in that, how people think about money. And one very important insight for me was that the way wealth managers think about money and the way investors think about money is very different. For us, money may be a number on paper or on an Excel sheet. For them, it's their life, right? And I think that bit of understanding that how people perceive capital, perceive investments, and what objectives have they put this out for is interesting. So for me, like at IFL Wealth, I ran a large part of the Western region practice initially, then went on to found and run IFL One, which was a solutions first platform within the wealth management industry. That scaled dramatically, and exciting learnings from that journey itself. And then sometime last year in 2020, there was this sense that, is there a way we can extend this sort of thoughtful wealth management, if you will, to a much wider group of users? And it really emerged from the crisis of March and April of 2020, when a lot of friends, relatives, family members started reaching out about their portfolios. And that's when we realized that there is a massive advisory gap here. The kind of portfolios that we saw was very, disturbing in some sense. And these are really smart people who had created these portfolios very ad hoc. And that's really the beginning of the concept of deserve, that you'd really deserve better with your money. And that's what we want to solve for.
Interesting. Sandeep, I was in a conversation recently, right? And just sort of picking up from what you said, right? When you started, right? And wealth was essentially not an abuse, but I think that's too serious a sentiment, right? But everybody was a wealth manager, right? I think everybody was advising on wealth without necessarily having access to that wealth, right? I think it was shallow, right? And you're absolutely right. That for the longest times we didn't have sharp people who understood a lot of macros and micros, right? Understood industries in and out. Were essentially taking those calls, right? And I think that led to what it did, right? And of course, it gave industry not a very serious thought that investors should have given, right? I think some sections of the sector and some players could sort of create that impression, but I think larger players were not necessarily there, weren't considered to be very, very serious, right? So we're going to move more into this up, right? Now, IIFL Wealth, we've known that wealth management, when you talk about private banking, is something which is typically carved out for HNIs, ultra HNIs, right? People who have that disposable capital upwards of $1 million to start with, right? And that also gives a wealth manager and a money manager, let me put it this way, right, that flexibility to go out, pick up assets, right, create a certain strategy, right, and not necessarily take one at the go. uh, what you're doing at Deserve is slightly different, right? I'd love to understand that, right? I mean, this is a product which is more for professionals, right? Tell me a little more about the construct of Deserve, right? And why this category, while that is a category which gives you certain flexibilities, this is a category which is more savings focused, possibly defensible, right? I could be wrong, you could correct me, but would love to know a little more
Yeah.
about.
So Ashu, actually, before I respond to what Deserve is really doing, I think it's important to go into understanding who the user really is.
Right.
Now, there are two types of investors, if you will, in the market.
Right.
One are people who really enjoy the process of investing, for
Right.
whom they would love to do their own research. And investing for them is more beyond returns. It's more about the excitement of it, the sort of intellectual excitement that they get from researching individual stocks, mutual funds, and then making those individual calls on portfolios.
Right.
And for that segment, a large part of the problem of access at low cost has already been solved for by the digital players. Then there is another group of people, and even I would put, while I'm a wealth manager, I'd put myself in that category, where I would like an expert to dispassionately manage my money for me, as opposed to me micromanaging it on a day-to-day basis. On every Saturday, do you want to spend time on your portfolio or with your family? Those are real questions that you need to ask. And the second thing is the number of choices has really ballooned in the last many years. We were just recently doing an analysis. There are nearly 8,000 mutual fund options, plans, and schemes to choose out of. There are nearly 1,500 investable stocks that you can look at. And there are over like 20,000 bonds that you can choose from. Now, how does an individual investor sit and select out of those if you're not excited about that? So for us, the process was, how do we reduce the complexity that is out there for our user segment? And that's what we are essentially doing. So the first thing that we said we will launch is a concept called integrated portfolios, which are essentially multi-asset portfolios comprised of equity, debt, global assets, and even gold and other instruments like REITs, etc. The challenge here is to find the right mix for every investor, and that's what our system really does. So there is the system really identifies, along with an investment expert, what kind of a portfolio you should have. An expert team at the back, run by my co-founder Vaibhav, they put together what kind of portfolio strategies we should have across all of these asset classes, and then what is the right combination of assets for every investor. And that's what the integrated portfolio offering delivers to every investor. So in that sense, today we are reducing those 15 to 20 decisions that an investor needs to take to create a high quality portfolio down to one decision. The second thing we said is that besides the integrated portfolio, today there is an opportunity in alternative assets, which typically the working professional segment has not had access to. These can be high yielding fixed income instruments. These can be pre-IPO deals. These can be global assets also. Now, our challenge here was to originate these transactions, diligence them, and bring them to the investors at a very low ticket size. So our promise has been that you will not have to go out looking for them. We will curate them for you, and we will bring them down to a ticket size of 20 to 50,000 rupees, and therefore make them accessible to you. So that's really the Deserve offering, integrated portfolios. And the moment you invest in an integrated portfolio, you start also getting access to these alternative transactions.
Very interesting. So these are very interesting points that you highlighted, right? Now, what I want to understand is, while of course you are delivering this through technology, right, and that's where the efficiency starts to come in, right? I mean, if you look at traditional models, something that you've been a part of, you've run, right? Given that the nature of investing, for this category, right, of people was bespoke, right? In your case right now, does it continues to be bespoke for each individual? So assuming you have 10,000 people who you're managing this money for,
Mhm.
hypothetical,
Mhm.
uh, is each portfolio going to be different, or have you been able to bring it to a point saying that this is your risk profile, these are the 8 9 possible product combinations, right? This is the one you fit in, right? Because the efficiency in both of these models is very different, right?
Mhm.
In the earlier part, it's been a human resource heavy business, and you would know that, right?
Yeah.
IIL, for example, and many others, right, have many branches, and they have relationship managers who go out and do that, right? In this case is more efficient, right? You can have much leaner team. You can very quickly sort of identify assets. You can manage them at the top, right? And very, very smoothly, swiftly you can do that, right? So
Yeah.
which is the approach that you're taking, or is there a hybrid which comes to fore, right? When you offer these services, love to understand.
Absolutely. Ashu, it's a great question. It's really a hybrid approach at
Okay,
its core. So, at the top, the whole investment construct of
sure.
what kind of assets will we have within equities,
Right,
within fixed income, global assets, etc., is decided by an expert team. Because we still believe that India is not at that point where everything can be run by an algorithm.
right,
There needs to be expert intervention. So we have created a very strong team of domain experts. So people who focus on asset allocation, people who focus on equity allocation, fixed income, and so on and so forth,
right.
who decide what will be the portfolio construct at the top.
Okay,
The second question is what is the right mix for the user?
right.
Okay. And that is where we have to listen to the user.
Okay,
What we do is we first have a set of questions which users answer.
right,
Uh, and we try and understand what is their investment experience like, how long have they been investing, what is their tolerance to downside, because a
right.
large part of uh, portfolio dissatisfaction, if I can call it that, comes from the fact that the loss is more than what I can tolerate, right?
Okay,
So all of these questions get asked, on the basis of which we create a portfolio strategy for that particular investor.
okay.
We also do one interesting thing, and that's the hybrid point, which is a Zoom call with an investment expert for the user. And
Interesting.
that really helps us understand if there is a nuance to the portfolio that we've built and if we need to further customize it for that particular user.
Right,
Over a period of time, we start learning from the behavior of the user also.
right,
How often do people come back to the platform? When do they come back to the platform? Do they
right,
add more when markets are falling, or do they get concerned about the markets? So
right.
that's the learning bit that the system learns from the user's behavior. But at the very top, the portfolio strategy is decided by an expert team, followed by customization depending on how the users responded to some of the questions we've asked, and finally the layer of personalization which comes from that expert call that we do.
Super. I have a very interesting question on that. But before I come to that, right, Sandeep, I'd love to understand a little more about research, right? We are in very, very dynamic times, right? And as soon as you start offering global products, right, I mean, you are talking of an added layer of risk, right?
Yeah.
And there are just so many nuances to it, right? I mean, something going wrong in a
Yeah.
country as small as Azerbaijan, right, and can have an effect on, can have an
Correct.
effect on currencies, which could further have an effect on your equity markets and so on and so forth, right? Gold could just go haywire, right? And silver could behave
Yeah.
completely differently, right? I mean, and that's how interconnected these markets are. Unfortunately, to a commoner, it's not visible, right? And we've done this, right? So we understand the
Sure.
complexity around it, right? What I want to understand is the research process that you put together, right? Because when you talk of any traditional organization which has offered a similar service, they've
Mhm.
raved about their research, right? Everybody talks about their research, and that is essentially to instill the confidence in investor, saying that listen, this is what we've done, right, and this is for you.
Yeah.
In your case, is there a difference in the kind of the way you do your research? I'd love to understand a little about that.
Yeah, so there are couple of parts of research, Ashu. One is the fact that the macro, micro, and that has been largely been solved for, and it's we also do it. There's a large team which does it. We use a lot of technology to be able to figure this out. So financial programming is a core part of the investment team. So
Right.
the idea is even on the investment side, it's a hybrid expert come financial modeling programming led approach. But I think there's one important layer, which is I think sometimes the investment research industry potentially can miss.
Right.
And that is the understanding of the user.
Mhm.
Uh, So one of the core learnings for me over the last many years has been that there are certain aspects that the user expects from your investment performance,
Right.
which is the returns, etc. And they articulate this very well.
Right.
What is hard for the user to articulate is how they will behave if the markets go down.
Mhm.
Uh, and using that behavioral finance approach to creating portfolios is also very important.
Right.
One thing which we do work very hard on, and that is potentially the differentiator, is not only to optimize for performance, but
Mhm.
also to optimize for downside.
Very interesting.
Controlling downside is a core feature of the integrated portfolio approach.
Okay.
It is our strong belief that when markets fall, if you're able to stay invested at that point, you will do really well over a long period of time. The
Right.
question is that most of these portfolios are not aligned to controlling for downside.
Right.
And that's where the investors get dissatisfied. That's when they break out of their compounding journey.
Right.
And really handholding investors through that process then becomes a challenge,
Right.
as you and I both have gone through. So
Right.
I think the core focus for us, besides outperformance, is controlling downside.
Right.
And that's something where, I mean, the models that we use work very hard on that.
Interesting. I would love you to throw a little more light on downside, right? Because I think that's a question that I think that's the one we've dealt with the most, right?
Yeah.
And I think for the categories that we've dealt with, typically, we've seen a few products, right, that came in and they were fairly complex products, right, for a market like India, and they used to a lot of hedge that used to happen between a spot market or and futures market and more FNO market, futures market, so on and so forth,
Mhm.
right?
Mhm.
We'd see a lot of butterfly being implemented and so on and so forth, right? But these are products that did not necessarily take off, right? In fact, there were certain products that backfired in a big way, right? And
Yeah,
the parent had to come in and kind of assuage the investors, right?
absolutely.
I know, I'm sure you know what I'm referring to.
Correct.
But in your case, how does it happen, right? Is it a mechanical process? Is this like a defined process saying that, listen, if there is a 5% swing or a 7% swing, right, we exit, right? Or,
Right.
we sort of say add further. Is it a more mechanical process depending on certain, binary outcome, or is this more dynamic and diverse
Yeah.
than
So Ashu, there are two ways of controlling downside in any portfolio. One is to introduce hedges
right,
through some of the FNO strategies that you were alluding to,
right,
right? Now the challenge with that is that it's not very tax efficient
mm-hmm.
when done in the hands of the individual investor,
Right,
and also it brings the complexity of margins and top up on the margin and so on and so forth,
right,
which are hard for the common investor to understand.
right,
So it's not only tax inefficient, but it's difficult to sort of assimilate all of this information.
right,
The second way of controlling for downside is by optimizing asset allocation,
right,
right? Which is where to figure out that at a particular point in time, what is the right exposure to risk assets
right,
versus non-risk assets that you need to take in the portfolio.
right,
Okay. Now, we have gone for the second approach, which is
right.
the asset diversification led approach to control for downside. Now, there are many ways of looking at downside, but we help an investor visualize the potential downside that they will have
Okay,
before they make an investment.
right,
What is the right tolerance that you have?
right,
Are you comfortable losing 10% of your capital from the top? Are you comfortable losing 20%?
right,
And so on. And that's really the input that we take and with which we work with asset diversification to control the downside.
right,
A lot of the assets that we do include are non-correlated. So
right,
they don't behave in the same manner at all points of time.
right.
And that's really where we get the opportunity to be able to reduce the fall in the portfolio.
Interesting. But does that help? Does that the early part of what you do, right, is understanding the individual and and kind of giving them a view that, listen, there could be a swing, right? From
Yeah.
that to it,
Yeah. So
we've
I
been
think
through 2008, right? I
it's
mean, we've been through 2008, right? I,
yeah,
in certain portfolios, saw a negative swing of about 60%, right? On
correct.
the principal, you know what I mean, right?
Yeah.
And it was difficult, right?
Yeah.
How
Yeah. So
difficult or easy is that?
it's an interesting process. So obviously there is this question about how much downside can you tolerate,
Right,
but then we also assess and we look at how long the user has been investing in the
right,
markets, right? So if I say that I've been investing for the last 2 years and I can tolerate a downside of 20%, versus if somebody tells me that I've been investing for 10 years and I can tolerate a downside of 20%, for the second person, I know that they have potentially been through that situation.
Right.
Whereas in the first case, it's possible that they may not have really experienced what real downside means, which is 2008. I think 2020 of March, April 2020 was a shorter lived downside. But when it came to what you and I went through in 2008-9, was a very different world, right? It took a long time for the markets to come back, an extremely excruciatingly painful process at that point. So I think it's also important to understand how long the investor has been in the markets. And how long have they experienced what downside really means?
Interesting. Sandeep, I want to talk a little about the risk profiling, right? Something that you alluded to, right? In your process of engagement, right? And onboarding a client, right? Now, if you look at risk profiling, right? Risk profiling typically has been a very two-dimensional process, right? There are certain forms that you go out and fill. I mean, and that happens. That's become a process, right? And I think that's also a process which is mandated by ANFI, SEBI, right, to understand the customer better, right? Now, I mean, we are very, very dynamic times, right? We have very interesting times. On a lot of occasions, at least something that I came across, right, when I used to do this, was that a client or a customer never had a complete view in the kind of savings that they had, liquid assets, illiquid assets, what could potentially come, their liabilities, their assets, also the industry that they work in, right? Which added to the complexity. Around the times that we used to do it, it was different. But today it's very, very different, right? Especially at the back of COVID, right? I mean, the world has transformed. It's changed, right? And how? We didn't go through a 5-7 year process of transformation. We actually went through a knee-jerk, almost an accident of sorts, right? Which pivoted us into using technology, right? Which essentially means a lot of people are going to have very different kind of risks, right? The longevity that they had to their careers is going to be very different, right? In businesses, they're going to go through a different kind of a pain, right? The liquidity condition that we're talking about in the hands of investors is going to be very, very different, right? What happens in an environment like that, right? How cumbersome is this going to become? What is your sense of it? Is what I would.
No, I think that's a great question. I think Ashu, to be honest, there is one approach to risk profiling, which is to say that you ask a set of questions or you understand the investor, and then you build that into what they are going to get over a period of time. The second approach, which is what we have signed up for, is that risk profiling is not static.
Correct.
It is an evolving. Everyone's risk profile evolves over a period of time. You are shaped by the experiences, the situation that you are in, right? And therefore, for us to profile our investors well, or the clients or members well, is very, very important.
Right.
So we do have capture a lot of information about their career, their work journeys, etc., as a part of the platform, to be able to use that information to modify the risk profile over a period of time. So while there's a starting point, there is a starting point of information. Then there is incremental information that we keep adding over a period of time. And this, by the way, only technology can allow you to do. In conventional wealth management, where there's a relationship manager facing you, there are changes in the relationship manager that happen over a period of time. Right. And when the change happens, the sort of information that the organization had about you as an investor has left with the wealth manager.
Correct.
Right. It's not baked into the organization's DNA. And therefore, the ability of the organization to continue to evolve your risk profile becomes really hard.
Right.
So I think that's where technology can solve for that. This information of changing behaviors can be captured and is already helping us modify the risk profile. So there are times when we start off with a certain type of a portfolio for a member, and then we realize like very soon that this is potentially not the right portfolio for them, and we reach out and readjust that, as opposed to taking the initial view, which is conventionally taken in offline wealth management, that you start with a certain thing and that becomes the fixed check the box profiling that happens today.
Sandeep, how cumbersome is that? I mean, this is a fun question, right? But how cumbersome is this, right? I mean, I know the challenges, right? It's a very difficult process, right? Because there are too many moving parts, right?
Yeah.
But in your day-to-day life, right, as the CEO, as the co-founder of this initiative, right, how cumbersome is this?
So
How much time does it take?
I'm quite excited about the fact that the technology platform has built this into the system itself.
Right.
So some of this information is being captured while you and I are sitting here doing this call, right?
Right.
So which are the days when the investors came back to invest? What was the
Right.
market movement on that day? A few days back, we had a major market correction,
Right.
as it seems to be happening right now as we speak.
Right.
But on that day, a lot of our investors came back to reinvest.
Right.
Okay. Now, what does that tell us about those investors?
Mhm.
Those are data points that the system is actively capturing to continue to evolve the risk profile of that investor. And that's
Interesting.
what is exciting. We don't have to do it in the quote unquote manual way that we used to
Right.
do it earlier.
Interesting. Sandeep, COVID has been unreal, right? I mean, something we kind of, I pointed out to in my earlier question, right? It was more about the risk, right?
Yeah.
But this is a conversation that is going to be heard by many people, right? I said some are going to get motivated to sign up on Deserve. Some are going to be motivated in general, right, about what's happening in the industry, and then some are possibly going to take away, what are some of the tips and possibly cues to manage their money better, right? What
Mm.
did you make out of COVID, right? I mean, as a professional who's been in the industry, who's had the opportunity of seeing many cycles, right, many asset classes, how do you look at COVID, right? What has it
Yeah.
done to the economy? What's your sense of it, right? What kind of risks have come in? What kind of opportunities have come in? What are some of those things? Love to hear your view on that.
So I think Ashu, every generation is known by for some of the experiences that they went through.
Right.
In our parents' generation, probably that was the 1940s, which is the World War or the independence or the partition or
Right.
some of those events that
Right.
played out. In our generation, that will be COVID,
Okay.
right? And like you said, it's unreal. Even today, when you, I mean, go back and think about a year or 2 years ago, the fact that you will not be meeting people and still be as productive or more
Right.
is just unheard of. The fact that if I told you 2 years back that such an event is going to happen, what will you think about the markets? You will
Right.
say that, look, there's going to be a phenomenal crash in the markets and markets will take time to recover. And here we are at higher levels than what we were
Right.
pre-COVID, right? So some of those things have really left a strong impression in the
Right.
mind of the investor.
Uh-huh.
And I think for me, there are two behaviors that have emerged.
Right.
And it's important to self-analyze which behavior that we
Right.
personally are into. The one behavior is the fact that this can happen again.
Right.
And therefore, you need to be cognizant of risk.
Right.
And that's one camp that is developing, that I
Right.
need to protect for risk, I need to protect for downside that can happen.
Right.
The second camp that very interestingly is developing is the you only live once camp, the YOLO camp, right?
Right.
Which is that what the heck, I have to get on with my life, and these things happen and these things come back, so I might as well enjoy my life right
Right.
now. And I think those two behaviors is what platforms like us have to adjust to or be
Right.
aware of.
Right.
And that's very interesting. The other thing that I think that's left a permanent mark on the markets,
Right.
in the sense that it has brought with itself a lot of new investors to the market.
Right.
Now, while the early gains that these new investors have made is very interesting, it's also important for us as industry professionals to analyze how these people will behave when markets
Right.
do play out their cycles.
Right.
Right. So I think that's going to be interesting learning. I'm quite excited about the fact that it's brought in a whole host of new investors into equity markets, fixed income markets, and which is really exciting.
Interesting. Sandeep, I think we cannot have a conversation without discussing the financial model, right? Because, I think financial services industry on one hand, of course, India has been a funny market, right? In many ways, right? I think, on one side you have, SEBI-like agencies and AMFI-like agencies who are continuously, putting out a word of caution. And that's largely because we're not necessarily very equity savvy nation. I mean,
That's
3% of savings is an equity, right? As an instrument, which is negligible vis-a-vis developed markets, right? Large part of our population doesn't participate in equity markets, right? So, they've been doing a lot of that. Uh, Also, what has happened is, and this is something that the industry professionals continue to sort of raise their voice and, around, is the the maths of it, right? Because to an extent, it's become unviable for many people to be in this business, right? We've seen an exodus of IFAs, who used to be there. We've not been, unlike Western markets, European markets, where there's a certain premium that you charge for the service that you provide, right? India is not a market where we've been able to sort of do that at large scale. I mean, there are some people who do that, but I don't think we've been able to do that at large scale, right? What's the financial model? I mean, there are many players who are coming up, right, who are enabling zero cost investment, right? There is no very clear financial model per se right now. And I think the fight is that of AUM. These are companies that are funded. The idea and aspiration is that, in future, we're going to have certain services where we could possibly monetize, right? We're in no rush. India is in a very, while it's been a market which has been there, it's still in its infancy, right? When it comes to adoption of financial products, right? Where are you on that, right? What's your take on that? I know there are no clear answers, but I'd love to hear from you, right? In terms of how are you prioritizing?
No, I think, Ashu, there are multiple nuances in that question that you asked. One is the fact that penetration is still low is a reality. I think there'll be far more inroads that investing space will make into households. India is in a situation where 15% or 15 to 16% of GDP equivalent is the assets of mutual funds. That number is 110% for the US, which means that even at the face of it, there is a 6 to 7x growth that mutual fund assets that potentially can have on the current GDP. And with the GDP also growing, you're talking about 8 to 10x growth of assets today. So that's very exciting. The second thing, like you rightly said, is the investor interest in financial assets is only now beginning to emerge. It's our estimate that in the next 6 to 8 years, investors of the population where people are making more than $10,000 and above, which is 7.5 lakhs and above, is likely to add nearly $4 trillion of financial assets into Indian markets. So I think that's the other exciting thing. The third point which you mentioned, and I think that's a very interesting one, is the number of advisors which are there to service this new emerging set of investors, right? India is a place where there are on an average 200 to 400 advisors per million households to service these guys. US as a country has 4,000 advisors per million households. So the gap of advisory gap is very, very large today. And there is one question to be asked is, how will this advisory gap be filled up? Will it be filled up by new advisors, new human advisors joining the market, or will it be filled up by digital platforms? I think the answer will be somewhere in the middle. But I think India will be uniquely positioned in a way that it will leapfrog from a point of having very few advisors to people getting advice, a lot of them through the digital platforms. So that's where our hypothesis is that a large part of these investors will natively use digital platforms for investing. In terms of the monetization and how does the industry make revenue, I think there are the what really the investors are looking for, and this is like after a lot of research, listening to a lot of folks, we've realized is for transparency. They do not grudge the high quality expert making money when they are investing for them. They, however, are looking for transparency in how much money are you making. They want to know that if I'm investing X amount of capital with you, how much will you make on a monthly basis from that pool of capital? And for us, that has been the core of the Deserve platform. From the very first day, we are telling investors how much exactly to the rupee amount will Deserve make from the investment that they do with us before they make that investment, and thereafter on an ongoing basis. So I think that transparency is what is very important. It's something that's been missing in the industry. There is an NSDL statement that you get once in 6 months, where out of a 30-page document, there's one line which shows where it is. Our job is to bring that upfront and be able to show it to investors and tell them that this is how many rupees that Deserve will make from your investment. And a lot of people are very excited with that just data point.
Is it? And what are the questions, right? I mean, are there? Are people willing to sort of go down that path? Because a lot of these platforms have also sort of brought in the notion that you can actually go on to manage. It's become DIY, right?
Yeah.
And I think the newer people who are entering, especially ones who are closer to 30, 35, 7 years experience, right? Reasonable jobs, large disposable capital, which is a huge emerging segment, right? They're getting into a DIY mode, right? Where you have platforms like Zerodha and a bunch of other small case, a couple of others who come in, right? Well, you
Mm.
think, listen, I'm a pro, right? I mean, I can read this and I can read that. I have a few hours extra on a day, on a weekend, and I can kind of manage it, right? Uh,
So there, like I said, Ashu, there are two types of
sure.
customer archetypes or users. One
Right.
is people who love the thrill of investing, and for them, they will go and do it themselves, and they
Right.
should do it themselves. Like if you
Right.
enjoy the process, if you're willing to invest time of 4 to 5 hours every week, you should certainly go and invest yourself.
Right.
But then there's another segment which wants experts to manage money for them, and it's really those that we are working for. In
Right.
terms of the whether users are willing to pay, and I park the deserved discussion on the side for a moment. If you look at platforms like Small Case,
Right.
they are already monetizing,
Right.
right? They're already charging. It's not free. Uh, so also, if you look at the portfolio managers, and that industry has really grown dramatically, the
Right.
fees is very visible to the end user. So
Right.
it's not that smart investors are not willing to pay. I
Right.
think the question that is a bigger question for them is, what value are you adding to my life?
Right.
Like, am I just paying for the heck of it, or are you really making a difference to my life? And the
Right.
moment they see that you make a difference to the quality of portfolio, to the kind of expertise that you bring, and to the experience that you deliver to them, a lot of people do not have a challenge with that. So
Interesting.
we don't see that pushback, to be honest.
Interesting. Sandeep, this conversation cannot be complete, without not talking about certain startups getting listed, right? Now there's a complete change, right? Because a lot of these assets, like in the West, right? I mean, you have the markets which are mature enough to absorb continuous losses, right, or ongoing losses. And the trade-off is that these are companies which are growing in GMV in terms of their customers, markets. They could potentially be making losses, right? And the customers are and the investors are comfortable with that, right? I mean,
Mm,
this is a relatively new in India, right?
mm, mm.
There are traditional investors, like Mr. Jhunjhunwala, right, who continue to question a lot of these markets, right?
Yeah.
Their thesis is that eventually it'll come back to me, right? At the
Mm.
end of the day, India is a profit-centric market, right? You have to deliver consistently on EBITDA, right? I mean, you cannot have bizarrely priced assets, right? Only because they have a certain chance, right? And then, of course, there is this newer generation, right, which believes in these assets, right? Who's adopting these assets, right? And they're coming in and investing in them, right? What's your sense of it, right? You are a startup yourself, right? And you handle a lot of money where there are a lot of people who, look at, consistency in return and stuff like that, right?
Right.
What's your take on this, right? I mean, that's you're a very interesting point, right? And I couldn't have let you go without asking
Yeah,
this
no,
question.
absolutely. I think so. First of all, it's really exciting that so many tech companies are listing,
Right.
because it's not only creating wealth for the founders of those companies, but it's also creating wealth for the employees of those companies.
Right.
And with that is this whole new generation of entrepreneurs which are looking up to this story and
Right.
thinking that maybe someday I will also be there, and therefore starting up. So I think
Right.
I'm very excited for the Indian entrepreneurial ecosystem just for that. And
Right.
on account of that, the new wealth creation will be multifold on the back.
Absolutely. Absolutely.
Now, in terms of as an investor, right, I think one thing which I have realized is that you cannot uh, pigeonhole yourself into a camp.
Right.
You cannot say that I will be a particular type of an investor, or I will not do a particular type of assets, right?
Right.
I think the every good investor learns on the job. You evolve, you react to market situations.
Right.
I think there is appreciation of the fact that some of these businesses will go on to become not only profitable but category defining or
Right.
category creating, right?
Right.
I mean, imagine somebody 5 years ago or 7 years ago told us that I would not have to step out and be able to order food at home
Right.
without, without actually calling somebody. It would have been unthinkable.
Right.
To me, some of these platforms like Zomato, Swiggy, Amazon, etc., have played a social role
Right.
during the time of the pandemic, right? I mean, we lived a normal life because some of them were there for us
Totally.
in
Right.
some sense, right? So I think there is a strong business model that can emerge. The
Right.
question is the valuation,
Right.
and sometimes valuations are guided by the emotional aspect of what people are feeling around it, as well as the economic reality of interest rates. Okay.
Right.
I think as investors, what we are doing is we are balancing these out better before taking decisions on whether we should invest in some of these new listings that are happening.
Right.
I think there are some very good business models that will emerge, and I think a large part of these new listings will survive and become much larger companies over the next few years.
Super. Sandeep, we're towards the end of our conversation, right? In interest of time, I'm going to club my last two questions as one, right, and put it out. I'd love to understand your aspiration for the next 2 years, right? Because we are at an extremely interesting time, right? Couldn't have been better. The economy is getting organized and institutionalized to a certain extent, and not in a bad way, right? We're becoming more predictable. We're becoming more homogeneous, right? Which is a very Western like we're becoming one large market, right?
Mhm.
Something that didn't exist, right? We were like
Yeah.
too many small markets that exist in one, right? And that brought in the dichotomy discrepancy, right? Being in terms of visibility, asset pricing, so on and so forth, right? And the challenges. What's the aspiration given we're becoming one, right? What's the aspiration for deserve in the next 2 years? That's question number one, as part of this. The second, you've been a working professional, right, who's chosen to build something, right? I'd
Mm.
love you to put out an advice for many people, who are at that fence, right? Who would want to take that call, but for a variety of reasons don't, right? I'd love you to, what will be the word
Yeah.
of advice, right, for many of them who could possibly jump in, right, and create something because time isn't better.
Yeah, both very interesting questions and very close to my heart. For Deserve, we genuinely want to make a difference to financial lives
Right.
of the working professional segment. I think that everyone is working so hard in their day-to-day jobs. But is their money working just as hard as they are? Is the
Mhm.
question to be asked. And at Deserve, we have that unique opportunity to be able to deliver a really high quality investing experience
Right.
using tech. For me, the big metric that we track is how do our members feel about Deserve?
Right.
What are they saying about Deserve? Are they happy with the service that they're getting? So there are
Right.
obviously secondary metrics like number of users, assets under management, and some of those things. I mean, we've been fortunate to get off the ground fast, and probably because of the fact that we are from the industry, it's
Right.
easier to for us to for people to trust us. But I think the biggest data point that we continue tracking is how are members reacting to what they are experiencing on Deserve.
Right.
In terms of people who are professionals who are thinking of starting up, right?
Mhm.
I think there's a lot of literature about entrepreneurship, about startup, about
Right.
product market fit, about analyzing whether how to get to market, what is the edge of the wedge, what, and all of that is important. It's
Right.
something to think about.
Right.
But I think as I said in another conversation, that you jump off the cliff and you build the plane on the way down,
Right.
right? So I think this is the best time for a professional to begin an entrepreneurial journey.
Right.
Um, all you need to brace yourself for is the uncertainty that comes with it. And if you reconcile with that uncertainty, I think this is a really exciting, and you are yourself an entrepreneur, you know this. It's an exciting place to be. You learn so much more.
Right.
And I think I would strongly encourage everyone to give it a try once in their life. And you either you succeed or you learn. There is
Right.
no other
Totally.
out on this. So I think that's what's the exciting piece for us is, and I wouldn't have changed it. Even on any, and we discuss it like the three of us co-founders are all professionals, right?
Right.
And we catch up every once in a while, and we think about would we have done anything differently, and the answer is a firm no. We have enjoyed every moment of it, and I'm sure everyone else who does this will also.
Sandeep, with that, we come to the end of a conversation. You know how I want these conversations to go on. My theme is, I mean, it's becoming cliched, right? I'll end up saying this by the end of each conversation, right? No, but this was an absolutely phenomenal conversation. Thank you for, giving us, an insight into how you're building Deserve, the ethos, right? And the value system with which you're building it. And of course, the role of technology, right? In terms of, being able to cater to a very large audience, right? Which is still picking up, right? Which still needs that hand holding, right? And you cannot manage that risk better without implementation of technology, right? You're absolutely right on many of those points that you've highlighted, right? And I love the way how you're bringing in that human intelligence into a system, right? And the continuity of ensuring that the advisory stays consistent, right? Even if people move out of organizations, right? Which has been a huge risk in traditional models, right? And this was an absolutely phenomenal conversation. How I want this conversation to go on, discuss many asset classes, right? That you talk about, but I'm going to save some of that for our next conversation. Hopefully, which we're going to have much sooner. Thank you so much for taking the time out. I think you're doing an incredible job. Wish you all the very best. And
Thank you,
it was
Ashu. I really
lovely
enjoyed
having you.
this conversation myself. And like we said, it's been a long time in the making. Uh, and good luck to the entire team at Asia Tech. We are very excited for what you guys are doing too.
Thank you, Sandeep. See you.